Hi, everyone. I am Cinthia Murphy, Director of Research at TMX Verify, covering in for Jennifer Nash, who's on leave. Welcome to today's show. This is Charts in Perspective. This week, let's look at the Fed's latest decision on rates and the impact on consumers. Every single move the Federal Reserve makes comes down to balancing two things: keeping prices stable and keeping Americans employed. That's the Fed's dual mandate. But right now, balancing those two goals has been harder than it's been in decades. Over the last year, unemployment has stayed in a steady band between 4.2% and 4.5%, but inflation, measured both as CPI and PCE, are proving sticky, and they remain above the Fed's 2% target. In fact, PCE, which is the Fed's favorite inflation metric, just came out last week at 3.3%. That was as expected, but it's still above that 2% mark. At last week's meeting, the Federal Reserve kept interest rates unchanged at 3.5% to 3.75%. To understand where we're going, let's look at how we got here. Post-2008, rates sat near zero for the better part of a decade. We saw then a gradual tightening up to 2.5% by 2019 before COVID hit. In 2020, we saw rates go down near rock bottom again. But what followed was 40-year high inflation. And because of that, the Fed had to hike aggressively between roughly March 2022 and the middle of 2023, when rates peaked between 5.25% and 5.5%. After some cuts in 2024 and 2025, here we are at 3.5% to 3.75% today. What's the market pricing in next? According to the CME Fed Watch tool, traders are currently pricing about a 65% chance of a quarter-point hike come September, followed by at least another hike before the year is over. When we look at that longer table probabilities, we really get the sense that the market expects higher rates from here. If that doesn't happen, then we could have a market surprise. These swings in rates directly alter things like 30-year mortgages, credit card APRs. They really impact everyday consumers. Which brings us to consumer sentiment. These swings really have been impacting how folks have been feeling about the economy. This month, consumers seem to be breathing a little momentary sigh of relief at the gas pump. But does that mean the broader economic outlook really is turning around? In July, the University of Michigan Consumer Price Index jumped 15.7% to land at 55.2. That beat estimates. That was the highest level we've seen since March, which was a record low for the index. What's notable about July's bounce is how broad it was. Sentiment improved across every group, regardless of income, age, education, or even political affiliation. 5-year business outlooks hit a 12-month high, and yet overall sentiment remains roughly 11% lower than a year ago. After 5 years of cumulative inflation, consumers remain laser-focused on one thing, which is their personal purchasing power. To see how people really feel, we look at the two sub-indexes in this index series. The Current Economic Conditions Index, which rose nearly 15% this month to 54.8. Meanwhile, the Consumer Expectations Index climbed a second straight month to 55.4, beating all forecasts. That tells us that people are feeling a little bit better about where things are headed versus where things sit today. The historical perspective gets sobering, though. Even with July's 7.5-point jump, sentiment is sitting at the second percentile in the index's entire history. At 55.2, today's reading is over 34% below its historical mean of 83.8, and it remains lower than the sentiment level recorded at the start of every single recession since the survey began. As we know, consumer sentiment drives nearly 70% of US GDP, consumer spending. Historically, when the 3-month moving average of consumer sentiment stays at these deeply depressed levels for a prolonged time, it tightly correlates with flat or negative GDP growth. A short-term bump like we've seen in July is welcome for sure, but sustained low confidence signals that we could be headed for some turbulence ahead. That will do for this week's Charts in Perspective. Thanks for watching. For more information and for more charts, check out advisorsperspectives.com. See you next time.